So what do we start looking at? Well, one of my favorites is, like I said before, economic value added and return on invested capital. And the main thing that I want to focus on here is CB&I and Dentsply really don't have the ROIC that I would like, or that express a very strong company over these average years. So if you look, Dentsply actually has a slightly negative over the last 2 years. They had one positive year and one negative year. 2011 and 2012, and 2010 was slightly positive. But nonetheless, if you look at their average, just not creating value with their projects. CB&I, positive economic value added, but a very tight margin, so something to be concerned about. You look at Marathon Petroleum, a very large economic value added, a very large company, which is why you see the $1.8 billion there. 3M, same thing, very healthy ROIC, economic value added, large because they are a large company. But then if you look, Albemarle's got a 10% spread, Pool Corp's got a 6% spread, CF Industries almost 12% spread. Very, very strong results for those companies. To move on to profitability and DuPont ratios, I've highlighted a few of the things I wanted to show here. Marathon Petroleum, you saw the large economic value added before. The profit margin it's lower on when you average or when you compare all these companies. It's a large company that depends on economies of scale, but still a profit margin of 4%. If we're going to split hairs among these 7 very strong companies, it's something that I want to see a little higher. That shows that they can absorb some sort of setback, over the course of the year. So something that I show as concern there. CB&I, a low profit margin as well, not as low as Marathon. Return on assets on the lower side of the comparison group. Dentsply, return on equity, the lowest of the group, the only one below 20. You got a return on assets at the lowest of the group, 6.3, and total asset turnover also pretty small. Which goes to show this company is doing really well because their profit margins on their revenues, or their profit obtained by the sales of their products, is actually very high. So it just depends on what you're looking for in the company, but I did note all of those as far as the comparison group and where they stood. CF Industries over the last 3 years really broke out. Incredibly high ROE, ROA, and profit margin. They're in the fertilizer business and just have been very, very strong with the rebound of the economy. 3M, right in the middle. Pool Corp, profit margin a little lower, which is something you've got to realize with a luxury business like Pool Corp, a lower profit margin, they got to keep churning them out. And then, of course, Albemarle is really just in the middle. Nothing really negative to say about Albemarle. Revenues and incomes. This gives you an idea of the size of the companies. We just talked about profit margins. You see Marathon Petroleum is a $75 billion company, the largest one among this group. 3M is a $30 billion company, also very large. The larger the company, the more stable for sure. But, of course, that doesn't tell the whole picture. The net incomes here are very related to the profit margins we just showed, but I wanted to give everybody an idea of how large these companies are. Pool Corp and Dentsply and Albemarle, actually your smallest ones. You get to CF Industries and CB&I, and they're your mid-range at $5 and $6 billion respectively. Earnings per share. Marathon Petroleum doesn't have a 2010 value because they split from their parent company in 2010, or in the middle of 2011. So you see here, earnings per share, very high for Marathon Petroleum. What I highlight here isn't necessarily what your earnings per share, what the absolute value is. It's actually how you increase per year. I think that's important. You got to keep creating value. You've got to bring your investors back. You got to let them know why they should invest in you. And as you can see here, the increase between 2011 and 2012 in Marathon Petroleum is very healthy at nearly 50%. CB&I grows at about 20 to 25% every year. CF Industries really broke out after 2010, like I said, and very high earnings per share numbers. 3M also climbing at a decent pace, and Pool Corp as well. Albemarle, solid, stable, but no consistent increase. So what does it really boil down to, right? Stock prices and dividends. We want to make sure we can increase portfolio value. So if you look here at average dividends, Marathon Petroleum, Pool Corp, Albemarle, really right in the middle at the 1 to 1.7%. 3M had a very high dividend rate. and CF, Dentsply, and CB&I at a lower dividend rate. Really looking at the increase in stock prices throughout the years, Pool Corp really broke out over these years when the economy started to rebound. A lot of people wanted to build pools, and so you see a very strong increase, a very, very strong, in fact, the strongest among the entire group year after year. Albemarle had a negative year and then a positive year. 3M, really sort of marginal. You got CF Industries that also had a fantastic year. And, of course, Marathon Petroleum, after their split in 2011, increased in value pretty substantially. PDE ratio, so your stock price is increasing, but you got to make sure that the market isn't overvaluing your company. Otherwise, it may not be worth it for the shareholder to invest. So if you look at the PDE ratio, it's really, just like stock prices, we're climbing. You see the PDE ratio for Marathon Petroleum's rises by about 30%. And then the really only other thing to note is CF Industries. What I wanted to note here is in 2010, they had a 17, almost 18 PDE ratio, and then their earnings skyrocketed, and their PDE ratio dropped. I think that's very important because they were a stable company at 17 on the PDE ratio. Now they're a lot lower because their earnings are so high. They maintain those earnings, it only makes sense that their PDE ratio equilibrate right back up to the 15 area. Risk and volatility analysis. Here's our beta and rho and relative volatility. Your relative volatility based on or with respect to the S&P 500. The ones I highlighted here are the ones that are a little more volatile. You look at Marathon Petroleum, a refining company. CB&I, an engineering company that's very, very heavily related to and depends on the manufacturing sector. If there's no projects, then they're going to have trouble keeping revenues up. CF Industries, another manufacturing facility. Albemarle, a manufacturing facility. So you see these are very strong companies that continue to grow, but they also vary with respect to the market. You look at 3M, a very large company that is really, really stable, only a little bit more volatile than the S&P 500. So that would be a good large company if someone was to look to invest and stay with the S&P's growth. They look to follow that, which it goes to show, they're a very diversified technology company. So with all their different products, their revenues make sense to follow that. So, important considerations, to kind of wrap it all up. All of these are fantastic companies. Looking at everything, I think they all have a positive future ahead of them. Exceptional performance over the last 3 years. That's why they were chosen out of that group of 22. So what does it really boil down to? Well, like I said before, a strong, stable return on invested capital, and that's your recipe for success. You really got to create value with your projects. That is an absolute must, which is what I say here with that economic value added. So that is how you maintain growth in your company and keep shareholders coming back. So here they are again, the last 7, and we'll go to final elimination. So 7th place, Pool Corp. I say that because it's a luxury business. People buy pools when they have a lot of money left over. Any extra money in the bank, that you can go buy a pool, you can go build a pool. It's really tough to maintain the growth they've seen. There's only limited areas to build these types of facilities or build these pools in people's yards or even commercial businesses. It's very, very heavily dependent upon the economy, and since it is not a necessity, I just wouldn't want long-term to invest in this company per se. Number 6 is Dentsply. The return on invested capital just wasn't there. Economic value added really wasn't there. Profit margin for this company is very high, and that's how they maintain their good performance. But as far as investing in a company and looking at the future and the ability to increase that value, this just isn't the company for me. 5th would be CB&I. Low ROIC, like we saw before. It had about 1% positive economic value, or ROIC minus the weighted average cost of capital. But the growth was marginal over the last 3 years, so if we're starting to split hairs once again, they're just not the one for me. And Marathon Petroleum, it boils down to low profit margin and very high volatility. I see this as a company with no room for error. If they have one setback at any of their large facilities, causes them to shut down for any period of time, it's going to be difficult to maintain that earnings per share. It's going to be difficult to maintain that profitability. So really no room for error for this company. So what does that leave? Albemarle, CF, and 3M. Who do we choose? I wanted to go back to what I feel is really one of the most important things, and that's economic value added. And you see here, all are positive, all have very strong ROIC minus weighted average cost of capital, with CF and Albemarle being largest. Who do I choose? CF Industries. CF really broke out. They, like I said, are a fertilizer company that over the last several years just really had outstanding earnings per share. Albemarle was marginal. 3M was growing. I do like 3M. But as far as it goes, return on equity, ROA, and profit margin were all there for CF Industries. I just think this company performed really well over this selection of years, and I think it's going to continue. Well, what else here? Well, if you look, the percent increase from 2011 to 2012, 40%. I think it's going to keep rising. And why is that? Well, I brought this up before, the P to E ratio. I really wanted to choose 3M. I thought about it long and hard. Their beta ratio and their relative volatility is just in line with S&P 500. It's not a very risky company to invest in. It's a very diversified company, a good company. 3M would be my second place. But the thing that I noticed was their P to E ratio is about the same as it always has been. So there's not really any additional reason for shareholders to want to invest in them because they've got a normal or a historically average price to earnings ratio. CF, on the other hand, if they can maintain these revenues, earnings that is, then I don't see why the market will want to elevate their stock price back to their historical average price to earnings ratio of around 15 to 17. So, in 2010 they made good money, but they had a high P/E ratio, and then they made even more money in 11 and 12, and it got suppressed. So I imagine that they will increase in value. Their one-year share price year over year, I believe, is going to be around $240, or about another 20% increase. Not the 40% they had before, but still a very solid increase for this company. And that's it. This has been Invest in the Best with DMcGraw. I hope Johnny Finance increases the value of his portfolio to the best possible.